Again, my name is Vinay Nadkarni of Clearbridge Investments here in New York City. Spring has finally sprung, and I'm happy to be hosting this call with my friend and colleague, Peter Bourbeau, co-portfolio manager on the Clearbridge Large Cap Growth Strategy. Clearbridge is an authentic active manager where we believe portfolios can combine concentration, valuation, and risk management to create a client solution that we feel is significantly different than market-based passive and factor-based solutions. As a reminder, this strategy is a focused portfolio of 40 to 50 names that tries to strike this balance between being purposely different, where we feel we have conviction and an edge relative to the market, while being relative risk aware so that what our clients and prospects should see is a more consistent, all-weather result that should lead to more consistent outperformance. We're thrilled to have so many new clients and prospects interested in this strategy dial in, and we thought this type of call, which we hope to do on an ongoing basis, would be a way to communicate directly with our investors. Our format's going to start with a moderated Q&A. I took questions that we've received in client meetings over the last few weeks about our investment process, both on the markets and specific names, and we thought would be especially interesting and allow Peter to speak broadly on those topics. Hopefully that takes about 20 plus minutes. And then we want to give those listening in, as Ian prompted you, to ask questions directly in an open Q&A format for up to an additional 20, 25 minutes or so. So Peter, thanks so much for being on the call with us today.
Thanks, Vinay.
So why don't we start with maybe taking a broad picture about kind of the markets. And one question I got in the last few weeks is, with so much news on the geopolitical side, the macro side, what's going on with interest rates, what's going on with trade policy, et cetera. The question is, as a firm and as an investor for 27 years now that's thought about the bottom-up and stock picking driving results, the question is, can a bottom-up investor truly ignore the macro anymore? And how would you answer that question?
Yeah, it's a fair question. And afternoon, everybody on the call. What I would say is it's I think flat out the answer is no. We've had accommodative policy for probably way too long, so almost every data point matters, and it's all incremental. You have to connect the dots, right? We've got ISM that's peaking, industrial production. We've got a view on inflation. Vinay mentioned rates, right? Which is, as an equity manager, you have to pay attention to credit quality and absolute spreads in the Treasury curve, and you have to listen to individual company commentary. They're telling you a lot more than you think. Now, what I would say is there are exceptions as well, right? There are, companies like Amazon has been asked for the multiple decades that we've been following them, what's the pulse of the U.S. consumer and so forth, and their answer, canned as it might be, is we don't know, right? They've been on the front end of such a secular growth continuum that they're not great barometers in terms of reads of various parts of the economy. Parts of healthcare share those same characteristics, right? If you're an innovative biotech company, you don't really care what's going on geopolitically or even in the U.S. from a specific basis. I would say there's some cloud providers today that share many of those same attributes, right? That the jump ball for tech spend is multi-trillion. And so the secular characteristics of some of these cloud providers is so enormous that they're not really going to be great barometers of the pulse of the economy. But we are more interconnected from a geography basis than we ever have been as a country. Order lead times are as short as they ever have been, and you can fact check that with semiconductor companies. And then supply chains are vastly improved and efficient. And so, again, if you think about all of this in totality, you have to pay attention to what your competitors are saying, and even tangentially what non-competitors are playing, if they are part of the supply chain. So that's a long way of answering the question, but I would say even for bottoms-up investors, you do have to pay attention to the highest level as well.
Great. So maybe the other thing, just maybe talking more about where people are in the market, one thing we hear is you've kind of seen this market kind of churn forward. There's been small bouts of volatility or downside, but it feels like, with low interest rate, there's always a bid around that. So the strategy's always been one that's historically had good down capture. But questions we've got recently is, like, if we look at investment or we look at kind of our databases, are the recent years as indicative of a true market sell-off, and our down capture, I think, on a trailing 5-year basis has been 85%. But given the portfolio construction parameters that you have in place have changed really since the crisis in 2008, how are you and Margaret really thinking about the portfolio being as defensive as you want it to be and as much as it's historically been over time?
Right. What I would say is, to some extent, I think we're in uncharted territory. We've got just the bolus of passive strategies and the flows into ETFs. Definitionally, right, you're buying stocks where you have no regard to the underlying fundamentals, and I understand the allure. I also understand how it worked on the upside. I think what we're figuring out right now is some of the dark underbelly characteristics of when ETFs are not just sold but also shorted, right? And we can see this on a day-to-day basis. There's almost no dispersion within the components of a member ETF when things are getting sold. So they're there for liquidity reasons, for funding shorts, but again, with no differentiation, you kind of see the day-to-day activities in the market, and frankly, it's allowing us to be a little bit more constructive, legging into new positions. But I think you have to differentiate why the market is going down. Is this just a liquidity drawdown? With a couple Trump barbs via Twitter? Is this something a little bit more sinister? I think that's frankly where we are right now. There's been a number of companies that have talked about peak earnings, high watermark, right? The unfortunate comment out of the Caterpillar call, which was a semi-disaster, was that exact comment. So are we on the cusp of a recession, or broadly speaking, just peak earnings? And that's the thing that we're trying to dissect, and the rest of the market as well, right? This is a very important earnings report. Earnings, you knew were going to be good. They had to be good, right? You had the kind of the first quarter of the tax gift, but at this point, listening to the forward commentary of portfolio companies and competitors is highly instructive. So we're trying to understand where we are currently. This is getting uncomfortable with the market action as we've seen it. I'd argue that probably 3/4 of the S&P today, right now, is in bear market territory. So if you look below the surface of just the absolute level of the S&P, which is semi-inflated with the kind of the top 5 tech names, there's a lot of damage being done below the scenes. These are opportunities for us, right? But it's instructive to pay a little bit of attention as to why they are down. But you look at things like defense, industrials, parts of healthcare, media, financials have been dreadful. Are they telling us something more? And like I said, this first quarter earnings season is instructive. We've got a team of 13 analysts that are sector specialists, and we're spending a lot of time making sure that we understand what companies are saying and why. I'd also say that as we look at this, we being Clearbridge Large Cap Growth, we kind of have a barbell strategy where we're very attracted, as most of you on the call know, to buying the unpopular names in the controversy, where we would argue the names are de-risked. And then the other side, we've got more than a handful of names that are leadership companies, super high quality, that to some extent create their own luck, and they can continue to do so with the cash flow that they generate. So this is a period, as grim as it sounds, that Margaret and I are pretty excited in investing, and we've added some relative ground in the last couple months with the drawdown, and we're finding some great opportunities as we speak. So the next time we talk, we'll have some great updates on some new names for you.
Great. So maybe let's transition to kind of the bread and butter, which is kind of stocks or sectors, and kind of your thoughts around that. So I was with your colleagues, Aaron McGreen and Brian Angerami, in their annual review with Vanguard last week. And one of their committee members, as they were kind of hearing us go through a few names, they said, that what I see as the edge of Clearbridge, or in particular with their strategy and growth strategies at Clearbridge, is determining that demarcation when a company is struggling on a price basis. Is that issue short-term versus long-term? In essence, how do you stay patient without being stubborn? I thought it was apropos of how you invest, and you just said it, given the team is often attracted to areas of controversy. So the NFL had its draft last week, right? And you saw plenty of shots of each team's war room. So with Chipotle and Alexion kind of having strong results last week, strong positive price action, maybe take us behind the curtain of how you stayed disciplined on names like that, where clients, frankly, were probably asking us almost every quarter, hey, when and if is it going to turn on those type of names?
Right. Good question, and it's probably a harder question to answer. And what I would say is that for longer tail growth companies, which for the most part are the companies that we invest in, few of these companies invest for quarterly results. You saw some angst last night from Elon Musk. If you didn't hear it at Tesla, that's not a portfolio company, but it's instructive as to how a founder thinks about his company and his prized possession. We invest in a company called Regeneron, and you had almost a similar reaction from Len this morning, who is also the co-founder, agitated at some of the questions from the sell side, started to, frankly, single some of these guys out and calling them overpaid and so forth. But I think you're seeing some frustration now because, like I said, the long-tail growth companies, I understand SEC requirements require them to file quarterly reports, but understand that for the most part, our companies are investing for a generation. And if you look at their capital projects, and you look at their R&D effort, you get readouts many years, into the future. Jeff Bezos at Amazon is probably the quintessential example of how this has played out. Now, granted, the capital markets gave him credit for investing all the way through, but I think that the street is being a little short-sighted in extending that to other companies. So. Like I said, we understand that they have to report 4 times a year, but for long-tail investors, if you are associated with the right management team, right? So I'll give you a couple of examples. Bob Iger at Disney, outside of the extra $100 million that Disney paid him, I think he did want to stick around and see how this was going to end and make sure that he's part of the solution with brand Disney. Jeff Bezos, I mentioned the same way. Frank Blake at Home Depot, when he took the reins from Bob Nardelli, he wanted to see and make sure that Home Depot effectively consolidated, the industry and put extreme pressure on those that remained. Satya Nadella at Microsoft, same thing. Almost the day he got the reins, he was the anti-Microsoft leader and changed that company for the better. Rich Templeton at Texas Instruments, he did some very uncomfortable things in repositioning that portfolio. Now it's a pure play embedded processing and analog company, one of the highest quality companies that we own in the portfolio. Bottom line is these aren't quick fixes, and it takes time, but returns on capital on the other side are usually meaningfully higher than going into these periods. So we are kind of frustrated investors sometimes because if you think about the delta around returns of this portfolio, they kind of coincide around quarterly reporting seasons. But if you kind of straight line kind of 2 to 3 years out directionally, if you have it right, these are opportunities to outpace the markets. Oh, and then specifically with the question on Alexion and Chipotle, let me take those in reverse. Chipotle, all the issues were fixable. It was a frustrating name. We bought this thing when we thought it was fully de-risked in the low 300s. We didn't understand the amount of pain that this company, or I should say pressure that this company was under for a period of time. And then, lo and behold, one day you have the change agent, Brian Niccol, the ex-CEO Yum Brands Taco Bell join, and the stock's up a quiet 60% with almost no change in operations. It's a breathtaking move, but coinciding with the list of reputable CEOs that I just laid out, a change agent for what he called an invisible franchise can do wonders for morale, wonders from the competitive positioning, and we were extremely excited to see him join the firm. But all of the issues that Chipotle had, in our opinion, were fixable. We'll see. It's early days, but we're enthused with Brian's early message on Alexion. This was a dog's breakfast of problems, right? You had some sales issues in countries like Brazil. You had debates about the longevity of their lead franchise, Solaris. You had some conflicts within the management ranks with aggressive selling practices. You had a failed acquisition, an expensive failed acquisition, I might add, which didn't translate to future sales. And kind of the same thing happened here. You had an experienced CEO join the firm. You had a very experienced CFO, a guy that we know very well. He was the ex-CFO of Biogen IDEC, very reputable executive in the space join. They cleaned house. You had some pipeline success with a product called 1210, which is the next gen Solaris. The way I would look at this is a de-risked biotech company that's trading at 13 times for high visibility, high teens growth over the next 5 years with patent protection. So you occasionally get these opportunities, and you have to know the story well, and you have an opportunity to add at advantaged prices.
Great. Thanks for that type of detail. So, you talked about Amazon before and Jeff Bezos and kind of, as you said, kind of innovative management team. So I got this really good question. I think I remember I emailed you on a Friday getting this question from somebody who'd come into our office and said, okay, so you guys were able to see something in Amazon, frankly, when most people thought they were going to go bankrupt, right, in the early 2000s, 2003, 2004. But why have you never gotten comfortable with Netflix, right? They both started taking out a traditional brick and mortar retailer. In Amazon's case, it was Borders, or in Netflix's case, it was Blockbuster. And then they took one core business and figured out just endless optionality. And yet you've been able to really ride and have a massive outperformance in one, and you've stayed away from the other. So I thought it's always just important to get how people think about these business models. So maybe just compare and contrast how you got comfortable over these years with Amazon and less comfortable to date with Netflix.
Another good question. In the early days, I'm not sure we had enough information, right? This is a period of time where the lead PM on the strategy was effectively sifting through the wreckage and carcasses in the Web 1.0 companies, trying to figure out who the survivors were, right? You had a lot of market cap that was eviscerated, and things like Yahoo, eBay, and Amazon were chosen as successors. Now, the absolute magnitude of the move in Amazon, and if you think about the way that Jeff Bezos wrote in his first annual, and it's still available for those that want to read it, his goal was to maximize the free cash flow per share. It wasn't to maximize revenue or earnings per share. So he told you early on how he thought about growing a business, right? He had an advantaged working capital situation, right, where you're paying Amazon before they paid their suppliers. So having that to grow cash flow was an extreme advantage from a business model that, frankly, the capital markets haven't seen. What he did with that, I guess that's the breathtaking part, right? This wasn't just about books. Then it became general merchandise, right? And then it became adding third-party sellers. Then it was fulfillment by Amazon, and then it was Prime, and then it was AWS, and then Whole Foods, and the list kind of goes on. But obviously looking for world domination in several sectors. But I think what he saw was that there's a lot of easy pickings out there. Right, that's not exclusive to Amazon, by the way. I think that Reed Hastings at Netflix, saw maybe a similar opportunity. It's not nearly as robust, but there's Airbnb and there's Uber and there's lots of very intelligent men and women out there with great business models that are looking at ridiculously large opportunities, right? Cloud computing, by definition, is the same thing. I guess one of the problems that we've had with Netflix is it's not as obvious as it was when we owned and still own Amazon as to how to maximize and grow free cash flow per share, and especially given the commentary that they're now tripling down in very expensive content, right? Effectively outbidding any sort of rational economics to lock up certain talent. The capital markets have been very generous in that strategy, but with limitations on how you grow revenue, right? This is a subscription basis and he's vehemently denied the fact that he's going to use advertising, which is another revenue stream that he's dismissed. It's not clear how they generate sufficient returns given the current price, even if they get 300 million subs from here. It's not apples to apples as to how we see it.
You always told me that Bezos said, hey, our one ethos is to maximize free cash flow per share, whereas, as you said, for Netflix, maybe you don't see that translation to free cash flow anytime soon.
That's a good way.
As simple as that, right?
Good way to sum it.
Let's close with maybe two sector views, and then we'll open it up for questions. So one is, how the heck do you make sense of what's going on in the healthcare space generally right now? Just a simple question like that.
So, Cardinal, for those of you that aren't in front of a screen, is getting decimated today, down 18% or so, and that's a pharmaceutical distributor, bringing the whole group down. There's a lot of change going on in healthcare. This isn't about Amazon or the fear of Amazon. There's structural issues that are way deeper going on in healthcare. What we're trying to do is twofold: is to either identify those companies that have some sort of innovative delivery mechanism for disease management, or finding companies that can fundamentally bend the cost curve in healthcare. United Healthcare is one of those, right? With an integrated model of regulated and unregulated business, it's truly one of one in how they're thinking about delivering, frankly, to the last mile. They are advantaged just due to their sheer size. Healthcare is a volume and size business. There's a lot of business models that flat out don't make sense. I think you're seeing that with the generics, and you're seeing that with drug distribution that relies on many generic and branded pricing. The thinking though is that if you can deliver a life-saving therapeutic agent, there's always going to be a market for pricing. We are a compassionate society. There is no rational human that will deny delivery of this therapy to the individual. But like I said, there's a lot of bad business models, and you fundamentally have to change the cost curve. The big problem is we have just too much chronic disease in the U.S. So drug as a percentage of total healthcare spend is hovering around 10%, and it has for 30 years. So the problem really isn't with drug spend, it's with all of the other issues, right? If you want to see true waste, fraud, and abuse, it's with the doctors, it's with the hospitals, it's with Medicare, Medicaid. So the fact that drugs have a list price makes them an easy target, but the real issue is delivering quality care to the masses, and that's why fee for service, or kind of the traditional delivery mechanism is ancient, and we have to find a different way of billing for care, and fee for total care is the way that the world's going to have to go to truly bend the cost curve. United Healthcare is working on that as you take on more and more doctor groups, and like I said, you're paid for success as opposed to per procedure. So this conversation can go on another half hour. There's lots of issues going on in healthcare, but those are the things that we're trying to understand better.
I've always thought that there's so many parallels between the healthcare industry and the asset management industry, and I feel like one of them that's happening right now is, to your point, it's the cost of the manufacturing it is under pressure, but frankly, it's probably more the cost of distribution and how we deliver that to an end client that's frankly got all these layers that's going to be probably more under pressure in the next few years.
That's it.
Why don't we close on the moderated Q&A? We'll go to tech because one of the things people have seen our buckets and how we kind of do contribution and attribution, and how those were strong performers for us in 15 and 16, and we'd kind of really trimmed from our mega cap internet exposure in 2016 and 17 to fund a more diversified set of disruptive tech companies. But I think, Peter, nobody would argue in your select bucket that companies like Palo Alto or Splunk or Adobe are optically, they look expensive. So maybe just walk the listeners on the call just kind of how you and Margaret think about evaluation on these companies that have these huge total addressable market opportunities, but are priced to really execute well within them.
Yeah. I would say that we're going through probably the third fundamental sea change in technology, right? Mainframe, then client server, and now cloud. And the jump ball, I would argue, is even bigger, right? Because now you're talking about multi-trillion. And listen, we're not Kool-Aid drinkers. We know there's limitations and there's a lot of buzzwords and valuations in some cases that don't make sense. But the addressable market for some of these applications and technologies are so enormous, and you're disrupting companies that have such a large installed base, that have huge maintenance and license contracts that are absolutely ripe for dislocation. You look at just in its early days, but you look at the run rate for Amazon's AWS in excess of $25 billion. Microsoft, their total cloud offering with Office 365 and Azure annualizing at over $25 billion. Google, Oracle, that will probably have a $20 billion cloud business by 2020, fundamentally changing the way that technology is being delivered. And if you think about it, it makes sense for the enterprise, right? Because you're taking CapEx and you're turning it to OpEx, right? So companies don't have to run data centers, private data centers anymore. Every server that comes out of the box effectively is depreciated by 50% on day one. All of that nonsense enterprises don't have to worry about, cloud security, et cetera. These are things that fundamentally are so large, and the movement is so enormous that we're such early days. And we've been taught, obviously, early in our career that when you see opportunities as big as this is, you don't use kind of PE necessarily ratios anymore. Obviously, you're looking more at price to sales and then price to cash flow, because out of the gate, some of these companies are so profitable on day one that you have to almost look at normalized earnings through the cycle. So we hopefully have some of the survivors in the group, but it is such early days. The interesting thing of for instance, Salesforce buying MuleSoft, that last chapter is not written. This is going to turn out to be, I would argue, a unbelievable acquisition and highly disruptive to some of the incumbents. So I know they always say that the technology acquisitions rarely work in the space. What I would say is you can still massively overpay for acquisitions and make them accretive if you have a long enough time horizon.
Great. So Ian, you can queue up if we have prepared comments from the people on the line. I do have an incoming question. So we didn't touch on a sector because one of the people asked, it said, and we talked about this during the February sell-off, about consumer staples companies not acting as defensive. So just thoughts on that group. I know we have much more on the beverages side than your classic kind of packaged goods side. So maybe that has been an area that people think of as providing downside protection and defensiveness. And how are you guys thinking about the consumer staple sector right now?
Yeah. Well, geographically, I sit next to our consumer staples analyst, and the guy's been in tears for the last 2 weeks through earnings season. This has been this has been eye-opening to see the action on things like Procter, General Mills, Kimberly-Clark, Kraft. The center of the store is in brutal shape. Organic growth is very, very, very low single digits. You're getting raw materials going in the opposite direction, right? So things like resins and ethylene and propylene and things for packaging are up 30 to 50%, and you have zero pricing power because Walmart and Amazon are putting the screws to you. So your margin is getting compressed, and you have low organic growth, and there's other modes of shopping. It's putting huge stress on center of the store consumer staples. The problem, though, and as a casual observer, you look at some of the companies like Coca-Cola that's growing organically at 5 or 6%. This should be a standout performer, and it hasn't been, right? And that is the ETF effect right there. It's a large a percentage of the various ETFs, and it's getting penalized as people are selling and shorting the entire group. But there are companies within staples that are dramatically outperforming, right? Something like a McCormick that's growing organically, that's the spice company, growing organically at 8%. I mentioned Coke organically and fundamentally changing their business model, growing organically at 5 or 6%. Costco, that is actually accelerating their comps. I'm not suggesting that's an inexpensive stock, but it's still a share taker in this environment. So we do own in Budweiser also in the beer space. U.S. depletions are horrible, right? We saw that with Miller Coors yesterday. But the big story for Budweiser obviously is outside of the United States, and they're still growing organic volumes in the mid-single digits. So hopefully we own some of the better performing, certainly from an operating basis they are, better performing names in the space, but it's been a painful go, and the problem is there's no signs of lift for many of those more commodity consumer staples companies that don't have product differentiation or distribution differentiation. Multiples are going to keep contracting, and it's hard to get excited about companies trading at 18 times, even with the drawdown, with only 2% organic growth.
And Rob's talked about this, that the brand differentiation, it used to be just kind of scale and those type of things for a Procter and Gamble, but in a world where a Dollar Shave Club or that type of thing, social media, those type, it can really undermine that strategy. And unlike, as you mentioned, you guys own Coke and InBev, those don't have generic equivalents. I don't know anybody who drinks generic beer as generic soda pop, but the other ones certainly do.
But to see things like Kraft down 50%, that's meaningful.
Yeah.
Right. That's cutting into bone.
So we just got another question come in because, and I think this is the value of the platform. We can own 40 to 50 names, but you really, through the intelligence and the accumulated knowledge, have a perspective on a whole host of companies. So you brought up Salesforce, MuleSoft, but we don't own Salesforce, right? And so maybe the question is just kind of, as you digested that deal, but it's not something you looked at. Any just thoughts or kind of why you've stayed away, or what are the things that you look at to stay on top of a name like Salesforce that's not a portfolio holding on an ongoing basis?
Right. It's a good question. Even though we haven't owned it, we've been analyzing Salesforce for a decade. This is not a new name for us. We've got great internal horsepower on the analyst side, especially in software, and we continue to do work on that name. Never say never. It's still an ultra high quality name, and they're looking to deliver, I would argue, a capability and a moat that they currently don't possess. In other words, they can be adding yet another growth leg to the story. So even though we don't own certain names, what I can say, especially as more of a large cap manager, is that there are very few names that we haven't done the prep work in, and maybe just looking for a better entry point.
Great. Ian, that's what we have from the web Q&A. Anything from the speaker line with star one?
At this time, I would like to remind everyone, in order to ask a question, you may press star then the number 1 on your telephone keypad. Again, that's star 1 on your telephone keypad. We'll pause for a moment to compile the Q&A roster. We have no questions at this time, sir. Please continue.
Okay. Well, we're at right about 35 minutes for the duration of the call. Why don't we wrap it there? We do want to just thank everybody for taking the time to listen. Hopefully, you found this helpful and instructive. Please follow up with us if there are any additional questions that you didn't get a chance to address. And we really do know that the way we can differentiate ourselves beyond our performance is kind of our client service. And so these type of calls and reaching out to our specialists and sales team to understand how we're thinking about the markets, how we're thinking about the portfolios is one of the things that we think we can do to distinguish ourselves in the active investment management space. So with that, have a great day, everybody, and look forward to the next set of calls that we do on Clearbridge Strategies. Thanks, and have a great day.